If you would have invested into ARK's innovative ETF this day, when Cathie Wood called into CNBC to say that she had a high degree of confidence in her companies, that they're taking market share, your current returns would be 190% as of today. Cathie Wood has been proven correct prediction after prediction. So the question is, if Cathie Wood has such good predictions, if she's been correct so many times, and her funds are performing so well, why don't we just invest in it? Why doesn't everybody invest in ARK Invest? That seems to be where all the money's being made. And that seems to be what most people are trying to do now. Just last month, December 11th, Cathie Wood takes the crown from JP Morgan for the largest active ETF. Now ARK Invest has a bigger active ETF than JP Morgan. JP Morgan manages over $3 trillion. This is an incredible feat. Investors are piling into Cathie Wood's ARK Invest, and that's where I want to give a warning. There's an article written by Ben Carlson, no relation there, but he says a short history of chasing the best performing funds. This is where he outlines what's happened in the past of different people piling into the best performing funds. The first thing that we can look at is the assets under management of ARK Invest. Look at this in just 2020. It went from what? $1 billion, $2 billion to $18 billion. That is an incredibly rapid growth. Investors are piling into this fund as fast as they can. And we can look at some of the examples of the past of what happened to the best performing funds after new investors pile in. Fidelity's Jerry Tsai, who is basically the first star fund manager of the go-go years of the 1960s. Investors went crazy for mutual funds in general as total fund assets grew a little over $1 billion in 1946 to $35 billion in 1967. The rate of ARK's growth is even surpassing this. So even in this example, ARK Invest has grown more rapidly. But Tsai stood out from the crowd. After a run of outperformance that began in 1958, Tsai saw the number of shareholders in his fund sextuple from 6K to 36K, from 1960 to 1961. So in 1 year, he had 6 times the investors investing in his fund. After leaving Fidelity in the mid-1960s to start his own fund, Tsai got crushed in the bear market of 1968 to 1970, which saw momentum stocks get killed. There was a reversal after that point. Assets fell 90%. 90% over the next few years, as Tsai's funds would go on to have the worst 8-year track record of any mutual fund in history to that point. So this was a complete reversal of one of these all-star investors. We can even look at the example of Peter Lynch, who personally, he's my all-time favorite investor. Peter Lynch ruled the 1980s, and for good reason. From the late 1970s when he took over Fidelity Magellan Fund through his retirement in 1991, Lynch returned close to 30% annually. Imagine that. 30% annual returns. This is where things get tricky. This is the breakdown between the fund's performance and the people investing in the fund. Unfortunately, the majority of investors in the fund received far less than Lynch's 29% annual gains. It's been said that the average investor in his fund earned just 7% per year, far less than the returns of the fund itself or the overall market because they rushed in after performance was good and they redeemed or sold out of the fund whenever it underperformed. So even though the fund over his tenure performed incredibly, the average investor didn't participate in all the gains. Most of them bought in after incredible performance and they sold out when the performance dipped. Ken Hebner's CGM Focus Fund was the best performing U.S. stock market fund from 2000 to 2009. He was named Morningstar's fund manager of the decade for the odds. CGM was up more than 18% annually during the last decade, which saw the S&P 500 lose close to 1% per year. The problem is investors tended to add more money after a huge year like 2007 when the fund was up 80%, and then they pulled their capital after it was down, like the 48% loss in 2008. This is the big issue with investing in these funds. With investing in funds like ARK Invest or Peter Lynch's Magellan Fund or CGM, investors buy high and sell low. That sell low, buy high strategy led to an average investor return of a loss of 11% annually. The best performing fund of the decade saw its own investors underperform the fund by nearly 30%. This is really stunning to look at. Investors do not perform as good as the fund that they're invested in. When asked about this phenomenon, Hebner replied, "A huge amount of money came in right after the performance of the fund was at its peak. I don't know what to say about that. We don't have any control over what investors do." The Mainstay Market Field Fund was a huge beneficiary of this investor demand after losing just 13% in 2008, a year in which the S&P 500 lost close to 38%, and when the fund beat the S&P 500 by 9% during the 2009 snapback rally, investors piled in at an alarming rate. Assets in the fund ballooned from just 34 million at the start of 2009 to more than 21 billion by 2014. That sounds a little bit familiar to me. Just like many of these other examples, all that money poured in just in time for the fund to underperform the market. From 2014 to 2016, that fund underperformed the market by 25%, and assets left the fund as quick as they rushed in. Now, I don't know if Cathie Wood is going to outperform the market in the upcoming 10 years or underperform the market like many other examples. Maybe she will be the Peter Lynch that has great annualized 30% returns for 12 years, or she'll be like one of the mini fund managers where her returns underperform the market after greatly outperforming it. This outperformance has been tremendous over the past year. Her fund has crushed the S&P 500. It's crushed basically every tech fund, and assets have piled into it. But my concern and my warning to people rushing into Cathie Wood's ARK Invest now is that your biases that may lead to underperformance still exist. They exist whether you're investing in Cathie Wood's ARK Invest, whether you're investing in the S&P 500, or whether you're just buying individual companies. The urge compelling you, tempting you to buy in after the returns have been remarkable, are the same urges that are going to tempt you to sell when things reverse. If this fund ever has a downturn, a significant downturn, and it starts to underperform other indexes or other categories, investors will want to sell. That's what will happen. That is human behavior. And you have to know that going in, that you are subject to these same behaviors as everyone else. Volatility can be very rewarding or it can be scary. When the fund continues to go up 2 or 3% every single day, that is something that you can look back and see how much money you made. But as soon as things reverse, and as soon as they go in the other direction, that's when you start second guessing what you're invested in. This is the same issue that investors had with Peter Lynch. Listen to how he explains he performed during market downturns.
Well, hey, this perfect record. I think the 13 years I ran Magellan, the market went down 9 times, 10% or more. I had a perfect record. I went down more than the market. Every time I went down more. So I just didn't worry about it.